The Russia-Ukraine conflict, now deep into its third year as of May 2025, continues to cast a long and ominous shadow over the global geopolitical landscape. Russia maintains its aggressive posture, aiming for Ukrainian capitulation and a perceived dismantling of NATO's influence in the region. Its demands, reiterated during the recent Istanbul peace talks, include severe limitations on Ukraine's military and territorial concessions. The human cost remains tragically high, with civilian casualties mounting weekly. Recent reports documented 1,402 political violence events, indicating persistent hostilities. Russian attacks resulted in at least 18 civilian deaths, while Ukrainian actions led to 13 civilian fatalities in Russian-occupied territories. Militarily, Russia continues its strategy of gradual advances, seeking to consolidate gains and exert continuous pressure. The international response remains a complex tapestry of support for Ukraine, sanctions against Russia, and cautious diplomatic maneuvering. The Russia-Ukraine conflict has injected a profound and sustained level of volatility into global markets, transforming investor calculations and risk assessments. Commodity markets, particularly energy and agricultural products, have been at the epicenter of this turbulence. Russia's significant role as an exporter of oil, gas, and grains, and Ukraine's similar importance in agricultural supply chains, means that any disruption sends immediate shockwaves through global prices. This heightened volatility necessitates a more agile and informed approach from investors. Traditional safe havens may prove less reliable, and sectors once considered stable can experience unprecedented fluctuations. Financial markets also reflect this nervousness, with equity indices reacting sharply to developments in the conflict. The uncertainty surrounding the duration and ultimate outcome of the war means that risk premiums have increased across various asset classes. Supply chain disruptions, which were already a concern post-pandemic, have been exacerbated by the war. Companies reliant on raw materials or components sourced from Russia or Ukraine face significant operational challenges. The conflict has accelerated certain economic trends, such as deglobalization or regionalization of trade, as countries and corporations seek to reduce their dependence on potentially unstable or adversarial nations. One of the most direct economic consequences of the prolonged Russia-Ukraine conflict is the significant surge in the defense and technology sectors. As nations reassess their security postures, military budgets are expanding at a pace not seen in decades. Western nations are ramping up defense spending to provide aid to Ukraine and modernize their armed forces. This increased government expenditure flows directly to defense contractors and developers of advanced defense technologies. The nature of modern warfare has spotlighted specific technological niches within the defense industry. Drone technology has become ubiquitous on the battlefield, driving massive investment into drone manufacturing and counter-drone systems. Beyond kinetic capabilities, the conflict has underscored the critical importance of cybersecurity. Companies specializing in threat detection, data protection, and secure communications are experiencing heightened demand for their services and products. The Russia-Ukraine conflict has dramatically reshaped the global energy map, creating a complex array of challenges and investment opportunities. Europe's drive to reduce its dependence on Russian natural gas and oil has triggered a seismic shift in energy policy and investment flows. This has led to increased volatility in traditional energy prices and a significant acceleration in the transition towards alternative and renewable energy sources. In the traditional energy sector, opportunities exist, albeit with heightened risk. Companies involved in liquefied natural gas infrastructure are benefiting from Europe's scramble for alternative gas supplies. The renewable energy sector is arguably one of the biggest long-term beneficiaries of the current geopolitical climate. Governments are offering significant incentives for wind, solar, hydrogen, and other renewable projects. The conflict has exposed the vulnerability of centralized energy infrastructure, creating opportunities for investment in smart grid technologies, energy storage solutions, and microgrids. Rebuilding and modernizing Ukraine's energy infrastructure will require substantial capital, presenting openings for companies specializing in energy technology and infrastructure development. Looking beyond the immediate horizon of active hostilities, the eventual reconstruction of Ukraine presents one of the most significant, albeit challenging, investment prospects of the coming decades. The scale of destruction is immense, encompassing residential buildings, critical infrastructure, industrial facilities, and public utilities. The task of rebuilding will require a colossal international effort and vast financial resources. Companies in the construction, engineering, and building materials sectors are poised to play a central role in this multi-year endeavor. There will be a particular need for expertise in resilient infrastructure development. Public-private partnerships are anticipated to be a key mechanism for financing and executing many of these reconstruction projects. For investors, this means looking for opportunities to partner with reputable international organizations and development agencies. Beyond the physical rebuilding, there will be substantial investment required in restoring and enhancing Ukraine's social infrastructure, including healthcare facilities, educational institutions, and digital networks. As of late May 2025, the geopolitical chessboard surrounding the Russia-Ukraine conflict remains intensely active, with several key developments directly influencing the investment climate. The resumption of direct peace talks between Ukraine and Russia in Istanbul marked the first such high-level engagement since 2022. Russia's demands include cutting off Ukraine from Western military aid and ceding several regions. These are viewed as non-starters by Kiev. President Putin's broader demands further complicate any path to peace. The Kremlin's signaling of territorial ambitions potentially extending beyond the 4 illegally annexed oblasts indicates a strategy of prolonged conflict. Militarily, Russia continues its efforts to achieve its objectives through gradual advances on the battlefield. Recent advances have been noted around Pokrovsk and Kostiantynivka in Donetsk, and near the international border in the Sumy region. For investors, these developments underscore the high-stakes environment. The intricate web of international sanctions imposed on Russia remains a critical factor shaping the economic landscape and investment decisions. As of May 2025, these measures have become increasingly sophisticated and targeted. The European Union's latest package of sanctions targets key Russian assets and revenue streams. The impact of these sanctions is multifaceted, contributing to Russia's economic isolation and straining its national budget. However, sanctions also have ripple effects across the global economy. They can disrupt supply chains, contribute to commodity price volatility, and create compliance challenges for international businesses. Investors must meticulously navigate this complex regulatory environment. The effectiveness and long-term consequences of sanctions are subjects of ongoing debate. Understanding the nuances of current and potential future sanctions is an essential component of any prudent investment strategy in the current geopolitical climate. The Russia-Ukraine conflict has sent commodity markets on a tumultuous roller coaster ride, with price volatility becoming a defining feature for investors. Russia's role as a global supplier of key raw materials and Ukraine's significance as a major exporter of agricultural products means that any disruption has immediate and far-reaching global consequences. Energy commodities have been at the forefront of this instability. Europe's effort to wean itself off Russian gas has led to a frantic search for alternative supplies. Oil markets have also been highly sensitive to geopolitical developments. Agricultural commodities have experienced significant upheaval, threatening global food security. Beyond energy and agriculture, the conflict has impacted markets for industrial metals and other raw materials. Diversification remains a key strategy to mitigate risks, requiring a nimble and informed approach to portfolio management. In this era of heightened geopolitical tension, adopting a prudent and strategic approach to investment is more critical than ever. Diversification across different asset classes, sectors, and geographical regions is a foundational principle. A long-term perspective is essential when navigating such turbulent times. Continuous monitoring and agility are paramount. The geopolitical landscape, sanctions regimes, military developments, and responses from international bodies are all dynamic variables. Investors must stay informed through reliable sources of geopolitical analysis and market intelligence. Exploring strategic partnerships can unlock unique investment avenues, particularly in relation to Ukraine's eventual recovery and reconstruction. By carefully considering these strategic pathways, investors can navigate the complexities of the current global situation and identify avenues for resilient growth.